Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, August 5th, 2019. It is 1:24 Eastern Time as I'm doing this, starting this video, and I had a member in the trading room ask me for an update on the semiconductor stocks, and I told him I'd try to get that out as soon as possible. You know, as the semis, in my opinion, have much more meat on the bone than the broad market and a lot of other sectors, as far as than next swing shorting op or this swing shorting op that we're in now. Figured it's worth updating. Now I'll try to remember to post an update to the video, the last comprehensive video. I touched on them since then along with the broad markets, but on July 22nd I posted an in-depth video covering the semiconductor stocks, the three main semi ETFs, which I'll touch on today. I'll hit on a few of the top leading semiconductor stocks. So we'll keep this one relatively brief. And again, if you're a new member to the site or you didn't catch that one on July 22nd, same level, same targets that I have here will be covered. The only thing different now is all the sell signals that I had said were pending in that video. The trend line breaks, that really is mainly the uptrend lines that have broken. The divergences, everything else were intact. So, we had the sell signals. Obviously, when tech broke, the semis broke along with it. And again, a lot of meat on the bone. However, I'm going to start here just recapping the broad markets and say this, that the rubber band gets stretched. It doesn't mean it can't continue to stretch. What I mean by that is oversold. The markets will only drop so much, so fast, and the more oversold they get, the more powerful the drop, the more that rubber band gets stretched, the more they can snap back. There's also another analogy I like to use, that you pull a rubber band hard enough, you can actually break it. And what that is, I made mention to that in the trading room today, actually under a reply to natural gas, which not related too much to the stock market. But my point there was, I've done this long enough to see there are certain points of time, and those only come when there's excesses. They don't come in a healthy market. You can have corrections in a healthy market. You can have sharp drops and all that, but what I'm talking about, a rubber band snapping, that's when everything breaks. And the only way it breaks is when you have an extreme one-sided trade, extreme bullish sentiment, the masses believing that the Fed's got the markets back, it's can't go down because of that, and it clears out a lot of short interest, creates that excessive bullishness, that coupled with valuations, and most importantly, where we are in the economic cycle. The trade wars aren't getting any better. There are some that expect no resolution until the elections are over, and that's going to be a while. I'm talking about our next presidential election. So it could be quite some time, whether it is or isn't. Right now, the point is, the charts are the bearish technicals that have been building and forming from the 60-minute charts, but to the more, as well as the more important daily and weekly charts, are playing out. We have sell signals across the board. Now, again, with that being said, so this isn't. I'm not trying to give double speak here about, oh well, the markets can go down or they can go up. No, the odds favor when you hit the each of these support levels favor reaction. We parked there, and there was support on the 60-minute chart on SPY last week, and then here's that support zone I posted this morning. These levels have been on my charts for many months now, and so we're at the bottom of the support zone right there. If you zoom in tight, you'll see that we're a hair below it, and there's a lot of downside momentum. And if we can't hold there, and so far, let me just say this, it feels like there's an elephant sitting on top of this market. The markets have been sandbagging on support, just as they did on Friday. They hit that support, had a bounce, but it was very muted, pretty much trade there all day and then gap below. That is indicative of a market with big problems, just a ton of trapped longs that want out of this market, imbalance between supply and demand right now. This is not, so far it's been a somewhat orderly correction. If you haven't traded for a while, you might think this is like a meltdown or anything like that. It's not. I've seen in even recent, months and within the last year, plenty of, 2.5% down days, 3% down days. It's not anything unseen. It's just, so far persistent and somewhat orderly selling. The way we've been walking down, if you look at like the let's say a 5-minute chart, and you just see, SPY kind of walking down here. There was some impulsive selling right after the Fed. All right, so that enough on that. I want to talk about the semis, but in that, you have to remember or keep in mind that I'll get to the levels there in the semis, but if the stock market holds support here and bounces, and again, I made it clear in the other videos. At most, I'm just looking for a, at some point we're going to have a counter trend bounce. Whether it comes now, whether it comes down here, whether we melt all the way down here, we know we're going to get a counter trend bounce. At this point, I outlined some levels that where it might go to if and when it comes. You have the bottom of today's gap, then the top of today's gap, a back test of this trend line and SPY. And the point is that the market snap back, especially QQQ, which has a lot of semis, it's tech heavy. The buying from QQQ and the NASDAQ 100 will carry over into the semiconductor sector. QQQ is now cracking below that 182 support and that potential uptrend line, going through it like it's not even there. We hiccuped on it today, where, like I said in today's earlier video, we were trading sideways. And see, here's the thing: we haven't like broken and then had that big waterfall type selling or impulsive. It's just there's just no bid in this market, no buyers. Any buyers are just getting absorbed by the sellers. This is persistent selling so far. So again, it's just not a healthy market. Keep that in mind. Now I want to try to give you levels because I get the same questions over and over. But guys, I like those questions. Don't get me wrong. I'm doing this. My point is, a lot of people have the question, hey, I've shorted semis, I want to know where to add to them, or maybe you didn't short, where to get in. All I can say right now is it's not very objective when you short. We're not oversold on the daily yet, but when you look at the intraday charts, like a 60-minute, we're extremely oversold. That RSI is buried down 19.23. Anything 30 or below is oversold. And the semis can certainly get more oversold as they did back here. At that point in time, there was our last short trade on the semis, official short trade. And by the time it hit our third target, we were already oversold before that. But we had nice divergence forming, and that's at the stage for the reversal. But the point is, look how long we stayed oversold. We hit oversold there, but now we're in an uptrend. So when you're in an uptrend, pullbacks to that 30 level usually spark the next rally. And then when you're also in an uptrend, overbought tends to become more overbought, like it did here, 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 and here. But then when you're in a downtrend, oversold tends to become more oversold or stay oversold. But again, it's all about risk reward, and when you have a sharp move down, just like a sharp rally up, the reversal, the snapback rally, the counter trend rally can come pretty fast. So here's my point: if you add to SOXX, if you don't have a short position, and you do, let's say, because I know a lot of people love those 3-time ETFs, SOXS and SOXL, that leverage up. So you have one of the most volatile sectors to begin with, down twice as much as the broad market today, almost. And so then you leverage it up, you're looking at gains well in the double digits on a single day, like today. SOXX would be up over 12-13%, should be, and likewise SOXL should be down. So there's my point, is that you need to, or ideally you want to wait for the next objective level, even if that means watching this thing come down a little more. Now you can nibble if you don't have a position, or you already have one, you want to add to it. Small amounts here, just enough that if you get that kickback rally and SOXX wants to backfill this gap right here, let's just try to quantify that for you. Let's just say, because that would be an objective level, I have resistance here at 199. If I grab this candle right now, the bottom, that's where we're trading. Just to go back there, you're talking, and again, this is the unleveraged ETF, SOXX. About almost 3%, and then if we come backfill that gap right there to the lower bottom of that candle, you're talking almost 4%. And we may go down quite a bit more. We may never backfill that gap. That's very possible. All right, so now let's look at levels where, and actually let me just start there. So if we do get a snapback rally soon, those would be objective levels. You also might want to just wait, because this is a powerful sell signal. And as I said in this morning's video, once you see something like this, the correction very rarely ends with just waterfalls, or not waterfall, but very impulsive red selling, red candles like that, and then boom, back off to the races. That's very unusual. Best, you're going to get a little kickback rally, then come down to support, maybe have some divergence on the intraday charts, or a selling climax, and then put in a bottom. That's at best. So at this point, let me just say this: Fibonacci's are one way. You can look at Fibonacci retracements on a kickback rally. I would target the shallower fib retracements, like the, maybe the 38.2 at best. At maximum, I should say, maybe a 50% Fibonacci retracement. These are fibs. You put up Fibonacci retracements like this, it'll tell you here's your 32% fib. And you can even put the 23.6 fib on there. That's a lower Fibonacci, and target that. You can see how that comes in right around the on a gap fill, backfill the gap. But again, that assumes that we reversed from right here. If we keep going lower, those fibs change. So again, that's just considerations. But to try to keep things simple and try to share my mindset with you guys. This tells me, and everything in that video, again, I would encourage you to look at watch the July 22nd video when you get a chance, because I paint the picture, the longer term picture. That's what I spent a lot of time focused on, weekly and daily charts. And it's this that tells me, just like we had the same situation back there, divergent high, overbought conditions, and we had at that point that big drop into the January lows. In fact, that drop, I'm just measuring out here, that was about almost a 30% drop. So I believe there's a lot more left in this drop. It's a matter of timing getting in. So enough of that. Let's now look at levels so you can trade off these as you want. So in that video, this is what I said had to go. We had these uptrend lines. There's three main semi ETFs. I'm talking not using the leverage ones. You have SOXX. I really focus on that one a lot because that also is the same index that SOXS and XOSL, the 3-time leverage, they trade. The SOXX Semiconductor Index, the PhilX SOXX. So on this one, this is the S&P Spider Semiconductor ETF. So it's different basket of semis with different weightings. Might have some of the same. A lot of the stocks will be the same. Some won't. And there it is. That is, in technical analysis, it really, honestly, doesn't get much better than that trend line as far as being very just clean, visible. Jumps out to the naked eye. You have to put a trend line there, and you can just see that trend. It's just very clear. And there it was. And the problem with these, we had because of the Fed and that whipsaw, we had to question those sell signals at the time. But then when we had the kickback rallies and everything started playing out, it became very clear, and especially Friday's move, that hey, it looks like that's the real deal. The Fed noise was out of the way and everything else. So here we are right now, and I want to say this. I use a term, I call it no man's land, and that is when a security is smack between support or the next target. There is some support above there a little bit. I could give you a line right there. I could tell you there's support right about here as well. But we're between support and resistance. Now resistance is all the way back. Forget about a back test of the trend line now. We've already moved too far away from it. You wouldn't want to ride out. And if for some reason we did back test the trend line, it would come in at such higher levels. It's just, let me just say that's not a consideration for me, because you shouldn't stay short for a back test all the way up there, and if it did, it's just going to muck up the charts. These are powerful sell signals that come out to the weekly charts. Really the semis at this point in time, in my opinion, have very little, if any, business getting back above the recent highs based on what's happened here before they go much lower. So that's that. I just wanted to show you some levels on XSD. Let's look at the weekly chart. Now again, if you're new to the site, I use different time frames. The weekly charts formulate the much bigger picture, the trend, where the next big trend is, and you can see on here, again, it was covered in that video, there's technicals like this that set up a move for a bullish trend, divergent low, bullish divergences, a well-defined downtrend line, breakout back test. Then you had an uptrend line here to buy pullbacks too, but at some point that uptrend became a little stretch, and you had the negative divergence, which warned of a correction. Might not look like much on this chart because it's a 10-year price history, but that little, quote-unquote, little drop there was over 21%. Again, divergent high, we're in an uptrend. So these were corrections within a larger uptrend. And you might argue and say, Randy, well, what makes this one any different? Well, again, covered in the video, you come out to the long-term chart and you go out to the SOXX and you look at the monthly charts. What this is telling me is, yeah, we've been in an uptrend, and even the corrections within that uptrend were, quote-unquote bear markets if you use the 20% metric for the drop. but they were corrections within a larger trend. But that larger trend didn't have any divergence. You can see the PPO healthily making new highs without any divergence, working its way up. Now we have some steep negative divergence. This is our primary trend line off the 2008 lows in the semis, and we're not even close right now to having that trend line being tested or broken, but it could come fast. That is the one thing about stocks in the stock market. Remember this, that stocks tend to fall much faster than they rise, and it is, especially in a sector like this that's very trendy, meaning you have these strong clear uptrends followed by sharp corrections or downtrends. You can wipe out in the semiconductors, and I've seen it before, and you can see it here. You can wipe out in a matter of mere months, years, many years of gains. You can wipe out in just days. You go out to the weekly chart, you can wipe out weeks and even months of gains as well. In fact, that's pretty much what we've done now since, here's last week's candle, and we're right here now. So pretty much we've wiped out 1, 2, these are weekly candles, 1, 2, 3, 4, almost 5, the previous 5 weeks of gains, strong gains. The bulk of the rally in the SOXX have now been wiped out in just 1 week and 1 day. That's all that is. 6 trading sessions. This weekly candle is just getting started. Maybe it reverses, but as of this point. So there's an example of why you shouldn't succumb to the greed. And when I talk about risk reward, and it's tough because you have a trend that's going up, but again, it was made clear back on that other video. And at the time, we didn't have any sell signals, and the trend was up, but we were on watch for them. The charts were indicating it was coming, and you can see here, since I've done that video, what do we have? Boom! It doesn't get any better than that. That big red candle, that's impulsive. It's big. You don't see a big red candle like this, the size of this, in the middle of an uptrend. Go back in time, look at these uptrends. When you see these big red candles, they come during the corrections. And so that's where we're at. So as far as supports go, let's just go through these weekly charts. It's not a hard level because there's been quite a few candles trading through, but roughly that 189.50-ish level. Then down here about 170. And this is where I think before all is said and done, at minimum, within the next year, could happen sooner. This is where the semis are going. So if you take that long-term outlook, and don't get too confused, or don't get too worried about levels. When I say, okay, we're oversold, we have divergence, we look like we could bounce off this level. If you're swinging for the fences, you want to hit a triple, a home run, or even a grand slam, there's another 25% plus downside, I believe, in the semis. And the only way to capture that is by riding out what will be some pretty powerful counter trend rallies. Here was a drop right here in the semis, right here on SOXX, that from that peak right there to the bottom, it was 27%. Again, remember, that was a correction in a larger uptrend. But the counter trend rallies, and this is the thing, this is where most people get shaken out. 18%, that was the first one, 18%. And still, I'm sure some of these were double digits from highs to lows. Another 15% that you would have had to ride out. But if you did ride that out, you captured the bulk of the trend. So these are things we'll be looking for. This 40-week moving average, we'll see, get prices below there. That'll help to confirm that we're in a downtrend. Of course, when we break that support level, I already showed you SMH, I believe, on the weekly chart. There it is. If I didn't, SMH, solid red candle through there. Here's our first support area right around here. I could move that line up a little bit, probably do that. Come in closer to those reaction lows. So that tells me that we're probably still coming down here before any meaningful, sharp counter trend rally. That's probably another 9% or so. And XSD, if that's the one you like to trade, I don't know why that line got moved. That's where the line should be. There it is. So they're all three. Here's the point. They're all three, all the main semiconductor ETFs with clear, unambiguous sell signals at this point, especially here on the weekly charts. The Fed noise, that's gone. That was last week. This is this week, and so these guys are on sell signals. There's your, on SXD, that was the breakdown. Like I said, impulsive, I think I already covered that one. Yes, I did. SMH. There it is on SMH. I did the video. We hadn't even yet made a divergent high. We have equalized. There's your divergent high, negative divergence. There's the breakdown. And again, we're sort of in no man's land, but I don't see really solid support till quite a ways down here. In fact, this chart, I'm not even crazy about these support levels. I would really just kind of focus on the weekly charts for these guys. It probably won't. I'll keep this short. No reason to go through each and every individual stock, but a couple of the big ones we'll just do. Intel's coming up on support, 46.50. Pretty decent, not the best. This is a big support level right here, about 43. I think that's where we took the stock long on the last pullback to 43. But if you're new to the site, here's my Intel weekly chart. Going back all the way into 2017, I started, focusing on this bearish rising wedge at this point right here, saying the next major sell signal in Intel would come on a break of that on the weekly close. There it was. There was our breakdown. At the time, I was calling for a 24 or 26%, 24% drop. We went up another just 2% and broke down like a week or so later. Hit that first target to the penny, bounced, but put in a larger, more powerful divergent high. Our next sell signal came on this big red candle, hit my 42.59 support level target once again, bounced from there, and then this is our most recent sell signal. You can see this trend line. Let me clean that up a little bit there. There's our most recent uptrend on Intel right here. We can come in, capture the previous lows right there, and boom. So that's the next breakdown. And at this point in time, because that level has already been tested, what I say often, it's the initial tag of a support level from above, meaning when you haven't done it in a while. It wouldn't be a support level if we didn't have other tags, but this is almost a year later, 8 months, 6, 7, 8 months later. That's the initial tag, so you're going to get a reaction there. And then sometimes you can have additional reactions, but the odds favor you tap. It's like tapping on a, let's say you tapping on, I don't know, a glass table or something with a hammer. You keep tapping, it's going to break. So I think the next time we come down here, we either have a very muted reaction, mild, and or balanced consolidation, or I wouldn't be surprised if we go right on through there and come on down to my next target here, which back then, I was calling for ultimately, my final, swing trend target on Intel, 32% drop. That's down to about that 38.27 level. And if we get there anytime soon, and remember, soon maybe, stocks tend to fall faster than they rise. It could take weeks, could take months, but I think it'll happen this year. We don't have that many months left in the year, so that's about another 18.5% drop. Taiwan Semi, and in this sideways trading range, looks like a stock that's been in a bull market. It has been, we can't argue that, but it seems to be topping out here, and this is a potential triple top pattern right here. You have one, let me circle these, circle tool. It's really a cluster there, cluster there, cluster there. Almost hit it there, but didn't. And technical analysis, to get the measured target of a double or triple top pattern, you take the distance of the pattern from top to bottom, and then you add that to where it breaks down. So if and when Taiwan Semi gets down here, you want to look for an impulsive break, solid weekly close, and that says the stock's going a lot lower from there. And I was just ballparking that drop. So I think Taiwan Semi probably has another 29 to 35% or so downside. Again, that's a longer term sell signal yet to be triggered. We may come down there and go on up, and then we're still in a bull market. But if we break that, that's a pretty powerful pattern. That will most likely tell me that the secular bull market in Taiwan Semi is over and a new bear market has started. So that kind of gives you guys an idea where things are at. The daily charts on these semis, as I went through them today, the levels don't jump out on a lot of stocks. Here's one at the bottom of a support range, Texas Instruments. I'm just trying to gauge, where the semis might bounce, and I don't have a very strong read, on the near term, how much more they have to go before they bounce. I think it's going to have a lot to do with if and when the broad market bounces. You can see, NVIDIA, again, a lot of these are no man's land. I don't have them at support right now, and resistance is quite a bit above. So I don't you know, there's not a very objective entry right now if you aren't already short. If you are and you want to add exposure, maybe just layer in a little bit. If we bounce 2%, add a little more. If we bounce 3%, but I'd be looking at, to keep things simple, about a 2 to 3% rally, kickback rally in the semis from this point in time, I think would be an objective area point to start adding some short exposure or even adding to an existing position. And as always with stops above, the charts could certainly change, the technicals could change. Here's one Qualcomm coming up on trend line support right there on it now. Here's one I'm not crazy about this trend line. Why? Because we didn't really have a third reaction on it, and but it's broken that support. So all in all, just let me keep it simple. Ugly charts, clear breakdown, sell signals. They haven't hit my, most of these haven't hit my minimum targets yet. So I think there's more downside here over this week, even whether we get a bounce or not. Let me just put it that. Try to zero in that tight for you guys. And then if you're looking out weeks to months, just a whole lot more downside. And if it changes, if the technicals change, it's going to take a lot. I said this with the stock market recently, before we even reversed. A week or two ago, I said it would take a lot more than a bounce or marginal new high for me to change my longer term bearish outlook. And that is because nothing that happens over the next couple weeks is going to change or undo all these bearish technicals on these charts. This is just one. They all look this way to me. Just major tops here. The same kind of negative divergence, overbought conditions, extreme bullish sentiment, everything that we had back here. At that point, that high in Micron marked a top before it dropped almost 100%. Yep, that's about 100% drop, close to it, 98%. And the only time we're going back, this is a monthly chart. Again, that's where that other video focused on the long term. Most people don't look out, or they don't have faith in technical analysis like that it can predict, where a stock is going in years, and they like to use the 60-minute charts and daily charts, but these things work more often than not. And whether or not Micron drops 98% again in the next bear market or not, I don't know. All I can tell you is that what technical analysis is all about: looking at identifying past patterns, development, price action, similarities in a chart, and then trying to recognize that and extrapolate going forward what it'll mean. And so see the same type of pattern here. Almost an exact the same divergence over the period of time. It looked like it spanned the same number of years, about a decade of divergence there on this. And it's again monthly chart here. Every candlestick's a monthly chart. And then you had an uptrend line that was the sell signal when it came, that confirmed that the top was in. First you get your divergent high, it's confirmed, then you have a trend line break, that's your sell signal. Micron traded sideways for a little while after the initial big leg down, but then just entered a new secular bear market, which again, as I just showed you, wiped out nearly all the stock's value. And that may be an exception. I don't, Intel, and anything's possible with any stock. Let me just say that now. But I'm not looking for 98% drops in the semis. That's just one that I happen to jump over to. All right, let's wrap it up here. And again, I like to at times when I can identify, sharpen my pencil and say, okay, here's where we, short right now. And just like with the stock markets recently, on the semis, I have what I call and what I've been referring to as a soft entry. Same with the stock market. I listed levels that we're breaking down, but look, the Fed thing is keeping it, the breakdown in question. The next day was Trump's tweet, but those were all objective levels. The breakdown itself, the back test, obviously the day after the Fed meeting, even the following day. With the confirmation, the additional downside, and that's why a lot of these we didn't capture them as official trades, because they were soft entries. But again, take it if you like it, stay away if you don't. And if anything changes in the technicals, I'll let you know. All right, as of now, that's my opinion on where the semis are going, and I'll be sure to update it if something changes. This has been Randy Finney with Right Side of the Chart. Have a great day.